Our next guest says momentum is on the investor's side, at least in the short run. Let's bring in Howard Silverblatt, Senior Index Analyst with Standard & Poor's. Howard, welcome. It's good to have you with us. And I like your little earbud. I have one, too. It's a good thing. Let's talk about how the market is performing this year. And you point out that we have something like 42, 43 new highs in the S&P so far this year. Even the best optimists might not have expected that.
I don't think anybody expected this amount. Last year was a good year. As you said, we have 43 new highs in the S&P 500. Today it looks like 44. Currently it looks like 30 for the Dow if we make it there. And there is an enormous amount of momentum. We've seen the market go down on several days, and then you buy the dips and you're back and with a profit on them. The momentum is coming not just from the Fed, not just from low interest rates, but also the Treasury and people getting back to work. So we've got a lot of momentum in the market. Is it nervous? Yes, we are very pricey right now, about 20.6 to 0.6 PE for 2022. But as long as you've got stimulus and people putting money into the market, money managers are going to stick around. They may be nervous and ready to sell, but if there's buying, you stay in.
And the alternatives are not exactly particularly delicious right now. Bonds at 1.2% on the 10-year. Obviously, there are other places where you can get some interest, but not much.
No, you have yields, which are still good, a risk reward, but they're only about 1.4%. You can get a specialty one that's probably about 1.8, 1.9. We'll go into a lot more risk, some LPs, but there's not a lot of places that you can get income right now. But investors aren't the only ones there. Q1, the S&P 500 Industrials had $1.8 trillion in cash sitting on the side. It made a little bit under half a percentage point. $1.8 trillion, and they got half a point. Not something they readily tell investors. So there's not too many places you can go for yields.
Let's say, Howard, I want to put some of my $1 trillion in cash to work here right now in equities. How would you divide it up? Where would you, for the next 6 months to a year, where would you put that incremental money that feels safe but also has a positive risk-reward ratio?
You've got to go for safety until you're sure where you're going to go. I think next 6 weeks to 2 months will be very telling. We'll see how the next employment goes, Jackson Hole, as well as the Fed meeting, and Washington, which remains a big concern. And then, of course, COVID with the back to school, which has, I believe, the biggest potential to take the market down if we start closing up schools or going down. As far as where you put the money, again, it's going to be your risk-reward scenario. There's not a lot of places you can put without risk. Companies are sitting on that money, and they want to invest. They've got a list of M&As. They've got capital expenditures. They are doing buybacks, a good quarter for buybacks. Dividends look like it's going to be a third quarter record for the S&P 500. So they are spending the money. They just have so much of it. Earnings were great last quarter, very good to great this quarter. Cash flow hit an all-time record first quarter. It looks like it's on track for this quarter to be a record. So they've got all this money coming in, but again, the risk-reward scenario is what's killing them and keeping money on the sideline. They don't want to less than that, that's for sure.